You're now listening to episode 65 of the Real Estate CPA podcast.
Your source for all things real estate, accounting, and tax. Here we reveal our secrets that can save you thousands in taxes, streamline your accounting process, and help grow your business. Stay tuned to hear insightful interviews with industry experts, successful real estate investors, and current clients on what strategies they use to grow their business and how they steer clear of Uncle Sam.
Hi everyone, thanks for tuning in. Brandon Hall and Thomas Castelli here today with Juan Vargas, full-time entrepreneur, multifamily syndicator, and host of the Commit to Wealth podcast. In this episode, we'll discuss Juan's journey from single to multifamily investing, why he invests in Texas, multifamily performance metrics, individual and multifamily tax strategies, plus much more. Before we jump into today's episode, I just want to let you know that we're putting on special year-end tax planning virtual workshops in September, October, and November of this year to make you aware of the tax strategies that might just save you a few $1,000s before the year winds down. If you're interested in learning more or want to sign up for one, visit www.therealestatecpa.com/virtual-workshops. Again, that's www.therealestatecpa.com/virtual-workshops, or follow the link in the show notes below, and we'll look forward to seeing you there. Juan, thanks for taking the time to come on the show today. Can you tell our listeners a little bit about yourself and how you went from a technician at BMW to a multifamily syndicator?
Sure. Hey, first of all, I want to say thank you to both of you, Brandon and Thomas, for having me on your show. It's a pleasure to be on here. So thank you so much for that. My start, as a BMW technician. That was after high school. I wanted to do something really quick. I didn't want to go through that 4-year college and that 4-year route. I wanted to help my parents out, and I figured, hey, do something that's quick. I was good with my hands, so I was like, hey, let's try this. So it was a technical school that I went to. I went to go work for BMW. It was a good career, but it's one of those things that's a skill set position. So the better you become in a skill set position, it becomes a trap. And for me, I started realizing that after a good while. I wish I would have realized that much sooner, but I didn't. And so, I started looking into different ways to create passive income, because I wanted to kind of get out of it, right? So I also had 3 kids, and that was another motivating factor for me. So I started looking into passive income and different sources, and there's a bunch of them out there. One of them that kept popping up for me was real estate. And also because my dad was already in real estate, he already had rental houses. And he even told me as a kid to get into real estate, but he did everything himself from A to Z, and he was under the sink and doing those kind of things. I'm like, man, I don't want to do this. I don't want to be, fixing, toilets and, fixing sinks and things like that. So I realized that he wasn't scaling up. And so, real estate kept popping up for me. And, sure enough, I ended up getting into real estate with some single family houses. And so that was my start in real estate. And shortly after that, I started to realize that single family was good, but multifamily was just that much better. And I really realized that in my hot moment was whenever I was vacant on one of my houses. And, guess what? If you're vacant on one of your houses, guess who's paying for everything? Is the guy that freaking signed on the freaking loan, or the guy that owns the house. And that was me, and so I paid for the mortgage, the taxes, the utilities and everything. And I was like, man, this sucks, man. This really sucks. I don't know why people say that, having houses is good, unless you scale really, really large, and you can do it that way. So multifamily was that next natural thing for me. And that's how I got my start into multifamily.
Nice. So you had 34 single family rentals, I believe. At that point, was it just becoming unmanageable, or what was it specifically, I guess, that made you say, you know what, it's time for me to let this behind and just go full time into multifamily? Was it that you just had to keep robbing one property to pay for the other, or was it just a scale issue?
Yeah. No. So actually it was at that moment, when I say the 34 units, I had 2 single family homes and then 32 units as a multifamily property. But yeah, it was more because you get the scalability in multifamily that you don't get in single family. And single family, for me personally, I know there's a lot of single family investors out there, and I'm not saying it's bad. I think it's good. It's just, for me, it was a scalability issue, because you have so many different loans, and then you have so many different insurance policies and so many different sites, and so many different roofs and so many different repairs, whatever. So it was more of a scalability issue or concern for me. That, and the other fact was the vacancy. If you're vacant on a house, on a single family house, you're 100% vacant. If you're vacant on a 10 unit, you're still 90% occupied. So that was another big factor for me in the jump, in making the jump to multifamily.
So you made the jump to multifamily, but what are some of the key challenges you faced as you made that transition from single family to multifamily? And maybe how long did it take you to really feel like you were more in the multifamily space than single family?
Yeah, good question. So, I mean, some of the challenges that I faced, for sure right away was as you try to go into multifamily, it can be a different space versus single family, which, and I'll elaborate on that. Single family, you can, find them all over the place. There's a lot of, realtors and, agents that sell single family. But, when it comes to multifamily, it's more, it's more of a specialty, I guess you can say. So there's brokers that specialize in multifamily. And so my challenge, in saying that was, I would reach out to these guys and tell them, hey, I want to buy some multifamily properties. This is my criteria. And they're like, okay, cool. So what do you own now? Well, I don't own anything, but I want to buy. And they're like, well, okay, but what do you own? And so that was the biggest challenge that I had was, these guys actually taking me seriously to the point where, hey, I can be a guy you can count on, and I will close on this property. And they will send me properties, and everything they sent me was pretty much junk. Things that everybody else had already seen, all over the place. So then that's when I took matters in my own hands, and that was via direct mail. I was like, okay, well, these guys are not going to send me some deals, so let me do this myself and send some letters out. Kind of like the single family side. And so that was the way I acquired my first 32 unit property.
Very nice. So you really invested in the direct mail efforts. So you were able to pick up some multifamily property. When you transitioned to multifamily, and maybe once you were into it for a year or two, did you notice any changes in your tax position? Was it better to own multifamily, or was it better to own single family, or did you pick up on any of that, or what are your thoughts there?
Yeah, no, definitely. That's a very good point. For multifamily, there was a bigger tax advantages for me personally. Everybody, obviously is in a different situation. So consult with your CPA, like somebody like Brandon. But for me, multifamily was definitely the better tax advantaged position there. Versus the multifamily. And I'm no CPA, I'm no expert in that, but it could be because of it was a higher purchase price. So you minus the land, which you can never deduct. So you have the actual property and all the belongings and all the items and everything that it includes. And so we're able to deduct that. And this was in 2016 when I acquired this property. So this is before bonus depreciation, and all that good stuff, which definitely we can talk about. And by the way, I'm no expert in this, again. So, but I'll give you my 2 cents in it,
Well, our podcast is meant to trick people. So I'm just kidding.
There you go.
We try to make you look good. It's fine, Juan. No, so with your multifamily purchases that you're making now, are you looking at cost seg studies and going through those motions?
Yeah. So we're syndicating properties now, right? So, one of the biggest advantages for our passive investors, is that they get to take a bigger piece of that depreciation or that loss, right? So, yeah, we definitely are doing cost segregation, and we're doing bonus depreciation on our properties. I think it would be stupid for us not to, because, it's there. And frankly, a lot of the investors, they ask, that's one of the first questions that they ask, if you're not doing it, then they're not going to invest in the properties. So you can claim it and do it now, or you cannot, if it's your choice really. But, I think if you're not doing it, then you're really missing out on opportunity there.
100%. A lot of our clients are looking for that cost seg and looking for those losses when they're investing with a syndicator or investing in their own multifamily property. And believe it or not, the more and more I read about, like read investment materials from other syndicators, I'm starting to see that taxes is a big factor for a lot of investors. They want to make sure that their real estate investments are tax advantaged. So definitely want to take advantage of that for sure. Yeah.
And so I'm also a passive investor, right? So, I've invested in some deals. I focus more on syndication now and taking down my own deals and, and all that good stuff. But even I was able to see that, hey, this is a good position here that we have right now. It may not be around forever. I mean, actually it's not, or going to be around forever because, unless it gets redone again or whatever, the whole tax, whatever you call it, the IRS, whole IRS code or whatever. But so you got to make sure you take advantage of these positions that you have right now. And that's certainly something that we're doing.
Absolutely. So we have everybody's listening just wondering, 2022 was the last year you're going to be able to use 100% bonus depreciation. It's going to phase out to 80% in 2023, 60% 2024, 40% 2025. And then when you get all the way down to 2026, it's at 20%, then it phases out completely. And no one really knows what's going to happen at that point.
Yeah. So that's why it's so very important, to do it now. And that brings me to another point, and this is a little bit off topic, but I'll go ahead and, I guess share it. And this is my personal opinion. So, a lot of people talk about, what inning we're in right now. Are we in the seventh, eighth, ninth inning, or are we in extra innings? What are we doing right now, right? But one thing, this is me personally, again, is, I see so many people interested in real estate because of the tax advantages that we have right now. So even if there was, some kind of, recession or some kind of, slowdown, I don't see that much capital slowing down and going into real estate. I see it still continuing to be a hot asset class, and people are still going to be dumping their money and investing in deals, not only because of the tax advantages, but that's definitely one reason why they're going to continue that.
I like the analogy to baseball there. What inning are we in? We've had multiple guests on our podcast over the past few months who have kind of alluded to the same thing. Nobody knows if we're at the top, but the general consensus is that we're more at the top than we are towards the bottom, if that makes sense. But that also means that you have to be careful about the markets that you're investing in and the types of assets that you're purchasing. So you said that you are heavily invested in Texas markets. What's drawing you to Texas markets? Is there like an indicator there, either qualitative or not? So something that is kind of drawing you to these markets? Well, talk to us about that.
Yeah, good question. So one reason is because I'm local, right? So I'm from Texas. I live in Houston. So that definitely does help. But, other than that, it's because, we have a lot of different strong indicators, for Texas, for the state of Texas. I mean, we're getting, job growth. That's probably one of the most important ones that you can see that you want to look at for a market is job growth. Because once you have job growth, then what does that do? That brings in population. People come in for the jobs. So then you have population growth, which we are having. We're having people coming in from the West Coast, from the East Coast, from both sides. So we're having job growth, population growth. We're having rent growth. Maybe it has slowed down the last 6 months or so, but there's still growth there. And one of the more important things is that we are a landlord-friendly state. That's also very important. We don't invest. We don't even look at anything like in California or New York or anything like that because they're not landlord-friendly. And I like New York, I like California, but it just doesn't work out for us. As a business strategy.
So talk to me about that. How is Texas more landlord-friendly than like in New York or California?
Yeah. So I don't know all the specifics about like a California, but I've heard of stories where people or tenants have stayed on properties for 6 months to up to a year. Whereas Texas, if you're not paying, then you're filing an eviction and you're out in 30 days. Something like that. So it's a lot more geared towards the landlords in Texas, a lot more landlord friendly, and that's why we look for these kind of states. Texas, Arizona is another good state, which we're actually closing on a property this week in Arizona. And, there's Georgia, Florida. Those are the kind of markets that we like and that we definitely look at.
Well, I tell you, I live in New York, and I know a bunch of investors who are from New York, and they absolutely can't stand the tenant laws here. Like, you should see to the extent they have to go to make sure that they're getting their leases done properly. Like, for instance, like this one guy, just, tangent story here, but maybe this is a good anecdote, right? So I was at an investment event, and he's like, all right, so the thing I've learned is I can't give them the key until I have the lease signed and the payment in my hands. Because if you give someone the key in New York and they take residency to your apartment, they pretty much have so much rights, you can't get them out. So it's like just little things like that you have to watch out for in New York. And then, I've lived in New York City for a while, and you see all these people who will, like you said, will stay in an apartment for 3, 6, 9 months before you get them out. And it's ridiculous to look. Not only you have to carry those costs, but they're living in your apartment for free. They're probably treating it like not nice. So definitely hear you there. New York's not somewhere you want to invest.
Yeah, it just is something that doesn't work for us, and as I said earlier, I mean, I like New York. I mean, I've been there, a few times, and it's a beautiful state, but it just doesn't work for us in the multifamily business,
Absolutely. So when it comes to evaluating the performance of your portfolio, what are some of the metrics you use?
Yeah. So, I mean, we look for, obviously, we want to make sure that we're looking at the occupancy, right? The economic occupancy. So we're always, on calls with our managers. We actually had a call just today. We had a call with our manager, one of our managers, to discuss, the performance of the property and what's going on. Are we getting the rent that we projected in our pro forma? Or are we not? What's the reason? How many units do we have down? What's the strategy to get new leads in? And are we closing on those leads? Those kind of things. So we're always looking at those kind of things. But, one of the most important things is how much are you collecting as well? So if you have people or tenants that are on your property and you're not getting your collections, then, that's a problem. And so we always try to make sure that our collections are, the best as we can get. And if they're not there, then we got to do something about it. And that's, either getting rid of the tenants, or just being a little bit more strict on that, So those are some of the things that, high level view that we try to do.
It's just, something you said in there is you push rents and economic vacancy and occupancy, all of that are factors. Do you have any challenges, or do you face resistance? Or maybe you could just speak a little about your experience about actually pushing the rent, right? So when you push the rent, do people try to push back on it? Like, how do you know when you push the rent enough, or how do you test the market?
Yeah, that's a very good question. First of all, it really depends on the market that you're in, right? We are fortunate enough to buy deals that were below market rents. So we knew what the market was doing, what the comps were doing, and if that's easy, I guess for us, it was easier because those guys are already getting that right around the property. So yeah, we go in there and we try to do it in segments, right? So we push as much as we can, the first shot, without getting rehabbed. So this is without getting rehabbed. This is just a unit that's, pretty much it's classic. We'll do some minor repairs to the units, and then push the rent, and then see if it pushes well. And so we've been fortunate enough, on some of our properties to get close to performance on the classics just by doing minor repairs. And then from there, we still have the upgrade package that we can do, and for an additional $50 or $75, And part of that is because of the opportunity that we found in these properties and found them in below market, state.
Yeah, so it sounds like that's really one of the big keys in multifamily investing, or just investing in general, is getting something below value, getting it below the market value, because then you already have built-in room to run. And then on top of that, above and beyond, you could repair it, you can make it more prettier, you could add more amenities, etc. Value add, and then you could push the rents perhaps even further, which is nice.
Right. That's was something that we've been fortunate enough to do, and very little. I mean, some of these were spending about $200 or $250 on upgrades, and those upgrades were literally some of the cabinet pulls and lighting fixture. There was a lighting fixture and a cabinet pulls, $200, $250, and we're able to push, $50, $60, just on those kind of things, So you're able to get your return, in 4 months or so, So that's the kind of returns, the kind of upgrades that we like to do. I mean, you put very little into the property, you get your return right away. It's good.
Actually, while we're talking about all this, something just crossed my mind that really just, when it comes to multifamily versus single family, right, is the ability that in multifamily, you can actually force appreciation. You can actually force the value of a building up through increasing the rent and minimizing expenses. Whereas with single family, you can do that to an extent. But first of all, you don't have the economies of scale. And second of all, it's not really how it's traditionally valued. So when you're selling a single family house, for instance, you might be selling it to a retail buyer, someone who's going to live in that house. They don't care on how much income that looks. They care about how it looks compared to their neighbor's house, maybe. So just something interesting about multifamily is it's much more like a business. It's valued much more like a business than say single family rentals are, which is nice.
Yeah. I mean, multifamily definitely is a business in itself. And you got to treat it as a business. And versus single family, single family was a whole nother story. I liked it. It was cool. But, one thing I like about multifamily specifically is that itself is a business. So each entity is a business, each property is a business, and you have to treat it that way. You can't treat it as a hobby at all, especially having investors in alongside with you. That's not good.
So switching gears a little bit, we've talked about some tax strategies like cost segregation and 100% bonus depreciation. Is there anything else out there that you're using, maybe even down on the personal level? Any sort of tax strategies that you're kind of using to optimize your tax position?
Yeah. So one thing that I've done, and I just did it last year, right? So it was to pay my kids, so I was able to pay them, and I paid them what it was, $6,000, I think it was what it was. And again, I don't know the numbers, but that was a number that I was told that I can do, without it causing a red flag or something like that. But so yeah, I was able to do that, and yeah, it definitely did help out on my taxes, with just claiming having my kids, work in the business, and it really did help out.
Yeah, and so to kind of elaborate on that a little bit, we love that strategy, right? We transfer wealth to our children. They work legitimately in our business in order to earn those wages. But basically, you get a tax deduction for the $6,000, and then your child realizes $6,000 of income but that's less than the standard deduction, especially after the 2018 tax cuts and jobs act. So they don't actually have to report any of their income on a tax return. They don't have to file a tax return. So you essentially create tax savings out of nothing just by moving your earnings to your children, assuming, of course, that they are legitimately working in your business. But we love that strategy because it just creates this long-lasting family wealth. So what are your children going to do with their earnings?
Yeah. So they actually want to, invest. They want to invest in real estate. So that's one thing that I've been teaching them and telling them about. So they made their money for last year, and they want to see how they can multiply that. And I'm going to be paying them again, this year. So that'll just multiply for them. I wish I had those opportunities when I was a kid. Like I didn't get those opportunities. These kids are small and they're legitimately working on the business, and helping me out. But just having the opportunity to be able to pay them, as well, that's awesome. And it's all legal as you can do that. So that's one of the beauties of the tax strategies out there.
Nice. So something else we noticed on your website when we were browsing around was that you have a library listed there. And if you had to pick one book to recommend, what would that book be and why?
Yeah. So, that's a tough choice, because there's a lot of different books, that I like. And some I need to add some more into that library. But I would say the cash flow quadrant. And the reason why I chose that one is because it's simple. I like Think and Grow Rich, but that one is a little bit more like you have to think about it and, those kind of things. But the cash flow quadrant is a solid book, and it kind of helps you to know, which side of the quadrant you want to be on. And for us, we're in the B and the I, right? And that's where we want to be able to reduce our taxes. And it kind of fits, what we're talking about here actually, because, you're in the B and the I, you're going to pay less taxes for sure. If you're in the E and the S, then you're going to pay, more of the taxes. So, that was a good book that I read. And it was actually after Rich Dad Poor Dad. And I don't know, I was supposed to read it in that order. I don't know if there's any way you're supposed to read it, but that's just the way I happened to read it. I was like, man, this thing, it just like blew up in my mind. And I was like, man, this is pretty awesome. And so that's why I recommend it to a lot of people.
100%. I read the Rich Dad Poor Dad book and then read Cash Flow Quadrant back to back. Like this was like 5 years ago now. And I'd say Cash Flow Quadrant's probably my favorite Rich Dad book, and it's up there with in my top 5 of the best books. So if people haven't read that out there, go pick that book up. It's great. It's a great book.
Yeah. I definitely recommend that one. Check that book out. And if you haven't heard of that quadrant, the ESBI, then it'll definitely open up your mind, and you're going to be like, man, your jaw's going to drop, and you're going to be like, man, why didn't I even learn this? Or, where have I been this whole time? So that's definitely a solid book for anybody listening.
So one question we always ask all of our guests is, what is the favorite piece of technology or mobile app that you're currently using in your business?
Yeah. So we keep it simple. So a couple that we use are Dropbox and Google Drive. And so in there, we have all our files. Everything's all in order, and it's just a way for us to share. And, it's all in one place. So Google Drive and Dropbox are like the two of them that we use like pretty much every single day, for our business.
Awesome. Yeah, we big fans of Google Drive over here, and big fans of Google. Google is just Google everything, right?
Yeah, same here. Yeah, I love Google for everything, so I gotta support them,
All right. Well, if our listeners wanted to get in touch with you or learn more about you, what would be the best way for them to do so?
Yeah, thank you for that. So, if people want to reach out to me, with any questions or anything, I'd love to help out. That's Juan at genwealthcapital.com. Juan at genwealthcapital.com. I'll be happy to jump on a phone call or, meet in person if you're here local or whatever, So I'm also all over social media. So Facebook, LinkedIn, Instagram, wherever you can find me.
Yeah, and you have a podcast too, Commit to Wealth, right?
I have a podcast as well. Yeah, Commit to Wealth. So you can check that one out on committowealth.com. I've had a lot of great guests on there as well.
All right. Well, thanks again for coming on the show, Juan. It was a great conversation. Look forward to getting this out there.
Yeah, no, thank you so much. I appreciate you guys and wish you guys continued success.
So we're here today on the debrief section of the podcast. We just interviewed Juan Vargas, and we discussed a lot about multifamily, some interesting tax stuff. And here we are to debrief.
Yeah, it was interesting to hear him move from single family to multifamily. I think that we see that a lot with our clients too. As they continue to scale, they just kind of realize that the economies of scale with multifamily is a lot easier to manage and maintain than it is single family properties, right? Like 35 units under one roof is a heck of a lot easier to manage than 35 separate properties. So you definitely have that economies of scale built in. But, I asked him about the change in moving from single family to multifamily homes from a tax perspective too. And it seems like he saw a positive change. But with a lot of our clients, when you apply the tangible property regulations that were released back in 2013, multifamily property is a lot more flexible from a tax perspective than single family property is. And to just give you a high level example, if we're looking at a betterment to a system, a unit of property, let's look at the HVAC system, for example. If we're looking at a betterment, and what I mean by that is we are replacing the HVAC unit. If I'm replacing the HVAC unit on a single family home, I am really materially improving the HVAC system as a whole. There's only one HVAC unit as a part of that system, so I'm arguably replacing 90% of the entire system in a single family home. But when I do that in a multifamily property, let's say it's a 10 unit property and I replace one HVAC unit, now all of a sudden it's really only a 10% or even less in terms of how it affects the entire system, right? So one HVAC unit divided by 10, I've only replaced 1 out of 10. That's only 10% of the entire system. That's not a material amount. And as a result, I have flexibility there in terms of how I treat that improvement under the tangible property regulations. I might be able to totally deduct it as a repair. It might not actually qualify as a betterment, adaptation, or restoration to the property, depending on the timing of it. So, when our clients move to multifamily property, especially if they have any sort of expenditures related to improvements, we always like to scrub those depreciation schedules, those fixed asset schedules, to just make sure that we are applying the tangible property regs correctly. But our folks that have multifamily property always come out way better off than the folks that have single family.
Yeah, we see that all the time, especially with the cost segregation studies and being able to really, increase depreciation by such large amounts. And, especially if you're also a real estate professional, it impacts you even more when you're investing in multifamily because you're able to take those larger losses against your ordinary income, perhaps from other businesses or jobs you're involved in, or perhaps even your spouse, which is always nice. But we kind of beat the real estate professional to death. But one thing,
for good reason. Good reason.
Yeah, I know. Absolutely. But one thing that I do see on the multifamily side with some of our clients, especially the syndicators, is that sometimes they prefer to capitalize a large portion of their rehab expenses to get it off of their P&L and onto their balance sheet. Because as we all know, NOI drives the value of multifamily real estate. And whenever you put a repair maintenance item on your P&L, you're driving down your NOI and then thus making your property look like it might be worth less than it is. But at the same time, on the flip side, you could be over-capitalizing items, I guess you could say, and capitalizing things that really should be a repair and maintenance expense in order to artificially inflate your NOI number. I remember when we were looking at properties back in 2017, when I was doing the syndication I did, that was one of the things we were looking for, was to make sure that people weren't pushing too much stuff to their balance sheet in order to, sometimes we had to back out some numbers.
Interesting. So when you were looking to pick up your deal, those are some things you were looking for. You're looking at the balance sheet to figure out what's been added to the balance sheet, and just making sure that in that example with the HVAC unit where they could be deducting it as a repair, they're just throwing it right on the balance sheet. And, the buyer might not be technically savvy enough to identify that. So they see a $10,000 higher NOI, which boosts the overall property value. Is that what you're saying?
Yeah, pretty much.
Now, if I go and buy a property and I do a bunch of rehab and expenditures, do you see a difference if there's like a short-term hold strategy versus a long-term hold strategy? Like I can imagine that as a short-term hold, I would want to put things on the balance sheet, right, to immediately start boosting my NOI. But what if I'm going to hold for like 5 to 7 years?
Yeah, well, then in that case, it might make more sense to expense some things to increase your cash flow. So I guess it all comes down to what your goals are for the property. What's the business plan? And that's going to kind of, in some ways, help dictate and drive the tax strategy and accounting strategies that you're going to have behind the property. Because like you just said, if you're going to hold for the longer term, you're probably looking for cash flow. And in that case, by putting stuff onto your P&L, putting your repair and maintenance expenses on your P&L, you're going to decrease your taxable net income and thus increase your cash flow. Whereas if you're looking to do it short term, basically flip the property, you'd be better off putting it onto the balance sheet so that when you finally do go sell the property, your NOI looks higher, or is higher. It is higher when you're going to sell that property.
Absolutely. So what do you think about the paying the kids strategy?
Love that strategy. Always love strategies that, while I don't have any kids yet, I do have strong philosophies. The way I'm going to raise my kids, they want to teach them the value of hard work. So not only can you teach them the value of hard work by paying them through strategy, but you're getting a tax deduction for it. So you're reducing the tax you're paying. They're getting it tax-free. And there's actually another component of that strategy, which we didn't discuss, which was the ability to take that number. I think the reason why Juan had gotten advice to pay his kids $6,000 was because of the IRA threshold of $6,000 that allows you to, pretty much a child could take the Roth IRA, take the money they earn, their earned income, and contribute it to a Roth IRA and thus grow wealth within their Roth IRA.
Yeah, good connection there. I'll talk about risk a little bit too. Whenever we kind of propose these types of strategies to our clients, sometimes we'll get questions about, well, how risky is this? And the key to mitigating risk is just substantiating the deduction, right? So if I have a 6-month-old child, I'm not going to pay them $6,000 for modeling, right? That's just never going to fly. But if I have a teenager, I can most certainly ship them out to the property for a day or for many days, depending on how unruly your teenager is. And I can have them work out there, do maintenance, yard maintenance, just like property maintenance, whatever I can get them a job for that they can actually do in their capacity as a teenager. And I can pay them for that. And that's totally legitimate. You do have to make sure that all of your T's are crossed and your I's are dotted. You do need a job description in place. You do need to pay them on payroll. But as long as you are doing everything the correct way, you shouldn't really be worried too much about running afoul of any sort of laws.
No, absolutely. One of my favorite strategies, honestly. All right. So moving right along into the Q&A segment of this podcast. Remember, during this segment, we do answer questions from you, the listener. So if you do want to have your question answered live, go to www.therealestatecpa.com/podcasts with an S and do drop your question and submit it in the box. And today we actually have a question from Tim. And Tim asks, how do you determine basis on a passive partnership investment? I get a K1 each year and all the details are here, but how do I find out and keep up with my basis?
Good question, Tim. So you really have two things going on here. You really have an outside basis and an inside basis whenever we're talking about partnerships. And without getting too crazy and into the weeds, your outside basis is essentially what you invested. Your inside basis is what you invested, plus the profits, minus the distributions, minus the losses, plus any liabilities that you might be liable for. If you are an LP investing in a syndicate, if I invest $50,000 into a syndication, my basis in that syndication is $50,000. If I receive a big distribution, let's say I receive a distribution of $10,000, my basis drops to $40,000. So I went from 50 to 40 because of that $10,000 distribution. If the entity shows a net loss, like let's say that I have a $50,000 basis and it shows a net loss of $45,000. Now my basis is only $5,000, meaning that I can really only take a distribution equal to $5,000 before we're going to have to really start getting strategic about how we're distributing funds to investors. So what you can do if you are investing as an LP in a syndicate or in a real estate fund, what you can do is get all the K1s related to that investment. It should show that initial cash contribution. It should also show either the net income or the net loss. So you can add that or subtract that from your basis. You can also add any additional contributions that you might make and then subtract any distributions that you've taken over the years. So if I looked at 3 K1s ranging from 2016 to 2018, I might see on the initial K1 the contribution of $50K. The second K1 might say a distribution of $10,000, and the third K1 might say another distribution of $10,000. Well, if we broke even all those years, my basis is going to be $30,000, right? It's the $50,000 initial contribution minus the $10K distribution in 2017, and then the other $10K distribution in 2018. So you really just have to go and look at those K1s and keep track of it yourself. We do highly recommend that you keep track of it. We recently helped a client go back to their syndicate and essentially have them correct their accounting records, because when we were tracking their basis, we ended up with a number that I believe was about $25,000 or $30,000 higher than what their the syndicate's records showed for that capital partner. And what that means is when you go and liquidate the property, our client was being paid out about $25,000 to $30,000 less than they should have been paid out. But we were able to go back and help them get that corrected. and get all that situated just by tracking basis, basically rebuilding it from the beginning, tracking it on a big spreadsheet. So that's kind of how you track it.
Yeah, and you know what? This kind of leads to another point too, is like when you're investing in a syndicate, you probably want to track your basis yourself. You also want to pay very close attention to the waterfalls that are outlined in the operating agreement to make sure that you're getting paid the proper amount of money that you're supposed to get paid back, including the return of principal plus any returns that you're owed, that you're due, because you signed that operating agreement. So just something else to think about. And remember, folks, if you want to have us answer your question live here on the air, go to www.therealestatecpa.com/podcasts, drop your question and submit it, and we may just answer it here live. Until next time, Brandon Hall and Thomas Castelli signing out.
Thanks for listening to today's show. If you enjoyed the show, please find us on iTunes and leave us a review. You can also email us at contact@therealestatecpa.com with any feedback or topic suggestions. We are always taking on new clients, and with the new tax laws in play, you really don't want to navigate this alone. Let us help you save money on taxes and with your accounting and CFO needs. To become a client, navigate to our client page at therealestatecpa.com and fill out a web form with as much detail about your situation as possible. Thanks so much for listening. Have a great rest of your week.